Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's 117th CP program organized by AASP of ICI this year. And today, again, topic is very important, that is the audit of business combinations. And in order to tackle this important topic, we are having with us Shri Jigash Parikji with us from our own Chartered Accountant fraternity. So on behalf of Auditing and Assurance Standard Board, I welcome you, sir, on this 117th CP program organized by AASP of ICI. Welcome you, sir. Namaste.
Thank you, Anilji, and a warm welcome to everyone. And thanks a lot for giving me this opportunity to share this knowledge with our fellow colleagues. What I will just
Sir,
share my.
before we start, before we start, it is my proud privilege to share with all the participants the brief profile of yours, sir. So I also welcome all the participants of today's webinar, and it is my privilege to share with you the brief profile of Jigarji. Jigarji is a chartered accountant with more than 22 years post-qualification experience. He is a subject matter expert in India's IFRS and Indian GAAP. He has extensive experience in providing various assurance and advisory related services to various industry segments like infrastructure, real estate, power, manufacturing, and others. He was a member of expert advisory committee of the Institute of Chartered Accountant of India, and as far as his skills are concerned, he has proficient skills in India's IFRS, Indian GAAP accounting expert, transaction accounting, and as well as the various trainings. He has given so many webinars and seminars to the various forums. Jigar is a senior member of Financial Accounting Advisory Services group of the firm, and he is a subject matter expert in India's IFRS and GAAP, especially in areas of revenue, business combination, consolidation, joint arrangements, and leasing. As part of FAAS Group, he is extensively involved in various advisory engagements ranging from GAAP conversion, transaction accounting, accounting advisories, consolidated assistance, IQ advisory, and advisory and training. He was part of the business combination and lead subject matter group of EMEAI region of Ernst & Young Global, and was also a member of Expert Advisory Committee of Institute of Chartered Accountants of India for the number of years. Jigar was a part of Technical Directorate, an external group for the firm which provides interpretive guidance on Indian GAAP related matters. He was also part of India IFRS desk of the firm and has played an important role in various critical IFRS arrangements. He also has experience in working on various international listings in the clients in his capacity as IFRS expert or technical viewer. Jigar has experience in providing various assurance and advisory related services to various industry segments like infrastructure, real estate, manufacturing, power and steel, technology, media, and entertainment. As far as his clients are concerned, he has dealt with IRB Infra, L&T Realty, Tata Realty, Mumbai International Airport, Delhi Build.com, large airport financial model review, and the list is still very long. So once again, on behalf of AASP of ICI, I extend my warm welcome to Jigarji on this AASP 117th program. Welcome to you, Jigarji. Now I request Jigar sir to please start his deliberation. Over to Jigarji, please.
Thank you, Anilji, for this introduction, and a warm welcome to each one of you. Good afternoon, friends. For next 1.5 hours, what I will really be sharing with you is for the topic with respect to business combination and what are the audit consideration with respect to business combination. I'll just share my screen and maybe Emil and Anilji, just confirm if at all, if my screen is visible to everyone.
Yes, sir. Yes, sir. Yes, sir. Perfect.
I guess what we are going to discuss broadly, I think this is next 1.5 hours. This is what we are really going to focus on audit consideration with respect to each of these items mentioned on the slide. And reason why I think if you see in today's era, businesses are getting very, very competitive and finding out ways to increase their profit and market share. It's very important way of really the inorganic growth is a very important way of really increasing the size of organization. A lot of time, the drivers is basically done in achieving synergies, getting economies of scale, market expansion. So there are various drivers for why companies really enter into business combination. And the way business combination is really done is also very, very different. And therefore, auditing business combination is very, very complex, because the reason why it becomes very complex, because generally all transactions are very high value in nature. They are a lot of fair valuation application is really there. So auditing fair value and getting that estimates and judgment becomes important. And many times you have to place reliance on third party reports. So really using the work of a specialist becomes a very important part of it. And also there are a lot of times you have to make a significant use of estimates and judgments, and that becomes very, very important. Uh, as you all know, business combination can be done in varieties of ways. You may do an amalgamation, you may do a merger, you can do an acquisition of a subsidiary, as a demerger, or there could be a slump sale, which is really there. And each of them can be regarded as a business combination. And either you can do a common control, it can be a common control transaction or a non-common control transaction. And we'll talk about all of these aspects a little bit in detail, more in terms of saying that what are the various attributes or what are the key consideration from an auditing perspective when we really do business combination, right? So business combination, when we say when someone really I think to really understand this topic, we will have to really understand the accounting nuances of it, and also then correlate that thing to the key risk which is really involved in each of those aspects, and what are the substantive audit procedures we really need to focus on to address those risks. I think that's what I how I have really structured this entire presentation which is there. And what I will be really doing in next 1.5 hours time is to really go to every aspect of business combination, and then understanding the accounting nuances of it broadly, and then really taking you through what are the key audit risks and what can really go wrong in that, or what are the key material risks which we need to address, and what are some of the procedures we as an auditors really need to really focus on. I think that's broadly the construct of this entire presentation. So let's start getting deeper into this particular topic. And first, let's take the topic about what is business combination, right? And I guess, as you all know, business combination is the word business has really been defined. But to really get control of a business, okay, you first, to really do a business combination accounting, you have to have control of the business. Under Ind AS, business combination is driven by standard Ind AS 103. The control is defined, and how to, whether we have got control or not is defined under Ind AS 110. Businesses, and if you really look at it, the way term business is very well defined. The business generally consists of an input, or there are processes which are basically applied on those particular inputs, which is therefore which is capable, and then which is helps you to really generate output. And as you all know, inputs basically, and one of the key example, inputs can be any economic resource or which has ability to create outputs. It can be like non-current assets, intangible assets, lease assets, anything which is really there. All those assets and thing will be there, which are input to a process. A process means any system, standard, protocol, conventions which are really there, which applied on those inputs has capabilities to generate an output. An output is obviously the end output or the goal. So let's say if at all there are machineries are input, the processes through which this machinery goes through really are the relevant significant processes, and output will be the finished goods or WIP, which is really there. While it may look very simple, but this is one of the very important aspects, because to apply and to do accounting for business combination, or to reflect a transaction as business in the financial statement, application and understanding of those definition becomes very, very important. And a lot of time there are judgments which needs to be applied whether we have acquired a business or not. So for example, if I will have given if I want to give an example which is really there, in this particular case, there are three case scenarios which are mentioned. If you see in case one, where let's say there's a company P which is planning to acquire a group of 10 restaurants. In one case, what they have done is basically there are various land, building, lease assets, employees, access to food, drinks, and supply agreements, which are really there. There are management operational processes, which are really there. If you see input processes and output, everything is there, and therefore it will be a business combination. If you go to case C, if you're really there, if at all, you just acquire input, but without having any processes which is really there, it will not be a business in that case. A simple example will be, let's say, on a real estate case, if you are acquiring just a company which has land in it, okay, where land per se is just an input, but if there are no other processes and it is just a standalone land owning company, it will be not an acquisition of business if that company is acquired. But if you acquire a restaurant or a company where there is a land, there is a building, that building is given on lease or it has been used to run a restaurant. And if you acquire that company, you not only acquire land, building, and other things, but you also acquire the operational processes, the knowledges, which is embedded in that part of it. And therefore, those inputs, those processes, when applied on those inputs, is capable of generating an output, and it will be regarded as a business. So assessing whether a transaction is a business or not a business is very, very important, because the accounting treatment for acquisition of business and acquisition of asset really is very different, is very drastically different. Some key aspects when you really think about the thing which is really there, the key aspect which is really there about what is business versus asset. In business combination, you have goodwill coming into picture. In asset acquisition, you never have goodwill. In business, you recognize all assets and liabilities at fair value. In asset, the price which you paid gets allocated in the ratio of fair value. In business combination, if at all you have a deferred tax liability been recorded on fair value adjustments, in asset acquisition, you may not be able to recognize deferred tax liability because of initial recognition exemption given under Ind AS 12. Transaction cost accounting, in case of business combination, all transaction costs get expensed off. In asset acquisition, it gets capitalized. As you can see, the accounting for business and accounting for asset can give you a very, very different result. And therefore, what is the business? So when the first time when you are really dealing with a client who has done a transaction, it's very necessary for you to then think about what can go wrong in this particular assessment. So if at all, one of the key risks will be that the company has not evaluated whether the transaction is a business or not a business properly. So that's a key material risk of misstatement which is really there. And how should we really negate that part of it? It basically requires that one will expect that management, there will be a proper evaluation which will be done by the management. So there will be a process by which a relevant person in the management at a senior appropriate level, someone will have done a detailed evaluation of it. And there is a maker checker which will really be there, someone really reviewing those part of it. So that process will have been there in the company system. If there is such kind of process, we will review the management analysis for whether transaction is a business combination or not. We will obtain all those documentation and evaluation to see why do management believe there are inputs, what are the inputs which management have identified, what are the processes which management is really focused on to see that these are strategic process which is capable of generating the output. And based on that, you basically is the assessment of whether it's a business or asset, whether that has been done appropriately or not. So I think the first key risk in any business combination, accounting or transaction, when you do an audit of business combination, will be whether the assessment of whether transaction is a business or an asset is proper or not becomes very, very important. And therefore, the underlying document, understanding the process which a company has, that who is going to do this evaluation is a very critical part, and how are they really documenting those things, a very significant part of the internal control financial statement of financial statements of the company. And therefore, it's very, very critical that we go through the understand that process. We do a walkthrough of those particular transaction and that evaluation. We see how those control procedures have been really applied for, whether there is an actual evaluation or not. Is there a maker? Is there a checker which is really there? Are they appropriately documented? We obtain all the necessary documents from the company, with the transaction document, the deal documents, the board resolutions, etc., the way and whatever relevant supporting to understand, to help us understand the nature of the transaction, so that we can really evaluate whether the assessment done by the management is appropriate or not. Right. I think there, if you see again, just going to the technical part of it, and as all of you know, there is in recent past there has been an amendment in business combination standard where there was an introduction of an optional concentration test, and why that was brought out to really ease out the assessment of whether a transaction is business or not. An optional was to really simplify the assessment whether it's a business combination or an asset acquisition. In a very simple way, what does this concentration test do is basically say that if the price which you are paying is concentrated with one single asset or a group of similar kind of asset, then and majority value is just paid for that, you will ideally say that this is an asset acquisition and not a business combination. You don't need to go through a very detailed evaluation in that case. But and standard lays down a very definite test or a formula to see how do you go about it. Let me explain you this with a very simple example, where entity holds 20% interest in entity B, and subsequently further acquires 50% shares in entity B by paying 300 crores. And if these are the asset which is really there, building is 1,000 crore, cash and cash equivalent is 200 crores, financial liability is 800 crores, the deferred tax liability, and etc. Now, fair value of entity B is 400 crores, and there's a non-controlling interest which is really there. Now, if you really look at it, what is the fair value of gross assets which is really there in this entire thing? You have basically fair value of gross asset which you have acquired is fair value of consideration transferred plus fair value of cash liability assumed, and on that you will really remove this cash and cash equivalent goodwill resulting from DTL. So if you really look at it, okay, this 300 plus 120 plus 80 is the total fair value of the asset. That is total 500 crores, which is what you are really paid for your stake. Okay, plus 800 crore minus 200, it's 1,100 crore. Total is the fair value of gross asset. Amount which you paid is 1,000. So 91% is the total thing which is really been paid for the thing. So here, if you see, building is 1,000, cash and cash equivalent is 1,200, which is really there. And you do certain adjustment for DTL and other stuff. Okay, and therefore that is 1,000 upon 1,100, 91%. Broadly, what you say is whatever value you paid, 1,000 crore is predominantly, 1,100 is predominantly for this building, and therefore that transaction is regarded as an asset acquisition and not a business combination. So one of the key risks, and I think when we really try doing all this tests are not, is a bit complex. So when you really have to understand the nuances of the transaction well, you have to do fair valuation of assets. If it is not done correctly, it can really give you a very different result. And for that, it's very necessary that we first acquire the entire fair valuation of each individual asset. We understand the fair value of the business, which is really there, or the transaction value which has been done. We re-perform the concentration test performed by the management to ensure accuracy of the computation. We test the fair value of the assets acquired and liability assumed, which basically mean that you may have to even involve your experts. So a lot of time, if at all, fair valuation is done through a very detailed valuation reports, which will be done by the company by hiring a third-party valuation expert. You as an auditor may have to involve your own specialist to test those particular fair values. And based on that, if your re-performance, by doing a re-performance, if you get satisfied with the business, with the value which is really done, then that the entire value is predominantly for a particular asset or a group of similar asset, it is a asset acquisition, right? So that is the test which you really need to do. And that will ensure that it is completeness, and valuation and measurement are the key assertion which we really need to worry about. Overview, I think once, what if at all, as I told you already, if something is an asset acquisition, then you basically recognize all the group of assets which you acquired by allocating the consideration paid in the ratio of the fair value. So you do not recognize any goodwill, capital reserve, or bargain purchase gain in case of an asset acquisition. So that is very, very critical. So one of the critical thing which is really there is that this entire evaluation is done by not a competent person. So when you really need to see is a part, if the company has set up a process that XYZ person in their company will be doing this evaluation, you need to be satisfied that they are competent enough to do this particular evaluation. That's one very important step. Otherwise, it increases the risk of misstatement, which is there. You also understand that this transaction assessment is approved by the appropriate level, those charged with governance, which is really there. So whether this transaction is a appropriate transaction or not, or a valid transaction or not. And therefore, the key audit procedures, which ideally, which we may have to really focus on, is review of executed purchase and sale agreement, review of minutes, review of management analysis. We need to also understand why this particular transaction has been done, what was the purpose of this particular transaction done, why which management has done. For that, you may have to really go through the deal analysis and other supporting documents which are really there. Because if we go wrong here, then you may really, a company may account for a asset acquisition as a business combination or vice versa. And that can really significantly change the way as assets and liabilities of that particular transactions are reflected in the financial statement, right? So that is something which is very, very important. I think the next big step, once having understood what is an asset acquisition, what is a business combination, which is really there, the next big step ideally is in a business combination thing is deciding is the acquisition method or application of acquisition method. There are 4-step process which is there. The first is identifying who is the acquirer, right? That is a very, very important part in any business combination. Second is what is the acquisition date, right? Because that date is the date on which you will do the purchase price allocation or you will record assets and liabilities from that particular date. And therefore, it's very, very important to decide what is the date from which one has to really do business combination accounting. The third thing is to really understand what is the price which has been paid, what are the assets and liabilities which we have assumed, and if it is not 100% acquisition, how should we recognize and how much should we recognize non-controlling interest. And last but not the least is then really computing goodwill, or whether it's a bargain purchase, whatever it is, that needs to be appropriately reflected in the financial statement. And each of these steps has its own challenges, and it is a very, it involves significant estimates and judgments. So let us go through each of these steps little bit more in detail, and then try to understand what are the technicalities in this, and what are the estimates and judgments, and what are the key audit risks which arises in that. So that each one of you, when you are applying this principle in real life, can really take care of this particular risk of misstatement. So let's start with who is the acquirer. First of all, I guess it's normal case for to us to say, as I told you, an acquirer is someone who generally is paying cash or who is really issuing equity shares. Or acquirer is someone who normally has a largest portion of voting rights in that combined entity. Or acquirer is someone whose management, who have ability to elect or appoint majority of the members of the governing body. And therefore, if you see an entity as a control, they basically, by virtue of this thing where they are the significant shareholder or more majority shareholders, or they have basically a right power to appoint and remove majority of the board members, they will generally be the entity who is basically an acquirer. But a lot of time, if you see the way transaction is structured, where legal acquirer may not be an accounting acquirer. And it can happen when a smaller body, let's say there are transaction which is really there, which is known as reverse acquisition, where you say that a smaller entity is acquiring a larger entity, okay, and in that case, the larger entity, even though it is getting acquired, is regarded as an accounting acquirer. A simple example, a practical example you can think about was in past, if any, the last one of the major transaction was ICICI Bank and ICICI Limited, where ICICI Limited was really merged with ICICI Bank. In that case, even though ICICI Limited was a larger entity, okay, it was an accounting, from an accounting perspective, it was an acquiree. It was an acquirer, but from a legal perspective, it was an acquire. It was getting acquired. So if you really think in that fashion, accounting acquirer can be, in a case of a reverse acquisition, may not be same as legal acquirer. So that is one thing. And therefore, it's very, very critical to analyze in any transaction when two parties are really coming together, who is the acquirer. Generally, acquirer is someone who will pay cash or who will issue equity shares, but it's not always the case. Let's understand this thing to a simple examples, which is also there. So let's say company A decided to spin off two of its existing business, currently housed in two separate entities, company B and company C. To facilitate the spin, company A operates new entity, company D, with nominal equity and appoints independent director. Company D signs an agreement to purchase company B and C in cash, conditional on obtaining sufficient funding. To fund this acquisition, company D issues a prospectus offering to issue shares for cash. At the conclusion of the transaction, company D will own 99% by the new investors, okay, where company A retaining only 1% of non-controlling interest. Just to sum up, if you see the current existing structure is company A owns company B, company C, and other subsidiaries. What by after the transaction, what it will do is the new investors will really pump in money in company D. Come through that money, company D will acquire company entity B and entity C from company A. In this case, who will be the acquirer? If you see this entire thing in this scenario, company D can be regarded as an acquirer, right? Because it is paying cash, there has been change of control, and in fact, company D is just acting as a conduit for new investors. So even though it is a new co entity which is really there, because it is paying cash and there is a change of control, it can be an acquirer. But if I restructure this transaction differently, let's say company A wants to create an enabling structure to facilitate sale of entity B and entity C. So instead of doing transaction in this way, they set up a new co. Same thing, company D was set up by company A only, and company D acquires entity B and entity C. Now the question will be, in this case, company D cannot be an acquirer, okay, because there is, if in effect, no transaction which is really happening. It is just really collapsing of entity B and C. So either therefore, because generally a new co can never be an acquirer if it is only issuing equity shares and there is no change of control. For a new co to be an acquirer, it has to pay cash and there has to be change of control. Those are the two conditions which is absolutely necessary. So if you see, there are a lot of practical estimates and judgments in assessing who is an acquirer. Things like reverse acquisitions, companies, a lot of time where company do a restructuring transaction to really facilitate a sale of this company or for an IPO. Those are transactions which has to be very carefully analyzed before deciding which party is an acquirer, right? So that's something which is very, very critical. Now, what is the key risk arising out of this to decide who is an acquirer? That evaluation of an acquirer under Ind AS is incorrectly done. That's the one major risk, right? And therefore, to understand that, one has to really see that, and other risk is that we are not aware of the purpose of the transaction, the ultimate substance of the transaction. That is not something which is fairly understood. So if at all, if I tell you where ICICI Bank and ICICI Limited, the same example which we spoke about, okay, if ICICI Limited is a bigger entity, and post the transaction, post the merger, majority of the shareholders of ICICI Limited were the significant shareholder, majority shareholder. Majority management of ICICI Limited became the management of the combined entity. if at all the significant stake or minority stake of ICICI Limited, in those case, it would have been very difficult if at all one would have said, no, ICICI Bank is the acquirer, right? So because if one would have just gone with the legal form of the transaction, they would have said ICICI Bank is the acquirer and they will fair value assets and liabilities of ICICI Limited. But if the evaluation is done correctly, you will see that no, ICICI Limited will be the acquirer and the assets and liabilities of ICICI Bank will be fair value. And therefore, if we do not do an evaluation correctly, this can have significant bearing on assets and liabilities measurement. And therefore, it's very, very critical that we do this thing well. So that's the first risk which is really there. Some of the other things which is really there is reverse acquisition or not. Example, or especially in a group restructuring, when there is a new co being formed to do a transaction, it's very necessary to decide whether a new co should account for transaction at book value or fair value. Because if at all a new co can do a acquisition accounting only if it is really acquiring control through by paying cash and there is a change of control. If these two conditions are not there, new co can never be an acquirer. And therefore, whenever a new co or transaction is done through a new co, one should be very mindful about whether these conditions are satisfied or not. And therefore, one of the key audit procedures will be to evaluate the factors in applying, in which framework we are applying accounting, looking at the management evaluation of who is the acquirer and what is the basis for that. And for that, one has to really have, let's say, a lot of data available with them. Who are the, what is the transaction? A post transaction, who will be the significant shareholder? Whose management is the dominant management? Who is basically whose minority interest or minority shareholders are significant one? Which is the larger entity? Whose net worth is more? What is the fair value of the business of each of those entities? I think those are some of the probing questions and data points which you should gather while doing this evaluation. Once you have all those data points, it's very, very critical. Then only you will be able to appreciate whether the analysis which is done by the management is appropriate or not. And hence, you need to really insist on getting the relevant data points, saying that please give us the fair valuation, business valuation report of the target and both the companies. Please give us the shareholding structure of both the parties. And ensure that, okay, who's the management, what is management before and after. So some of those things, data points you should really obtain to understand and do this proper evaluation. Then only one will be able to appreciate whether the transaction is appropriately evaluated or not, and whether the acquirer, who is the acquirer is properly done or not. I think that's the first step. The next step is, what is the acquisition date? Generally, the date on which acquirer legally transfers the consideration, acquires the assets and assumes the liability, that normally will be the closing date. However, that there might be a case when your closing may happen earlier or later because there are condition precedents. One needs to understand those conditions really well to decide whether the date will be other than the date on which we transfer the consideration or not, right? And therefore, it's very, very, it's a bit judgmental exercise, especially when there are court orders where transaction happens through court schemes, or when there's an acquisition where there are conditions which are, condition precedents are laid down, or the or transaction approval is subject to regulatory approvals. That really is what really decides, and therefore in those kind of cases you really find a lot of judgment being have to be exercised of deciding what is the acquisition date. So if you see, let's understand this thing to a simple example where company has signed a purchase agreement with company B on 1st of July. That means and the agreement was, I think the purchase agreement was filed with High Court for approval. Now it's an NCLT for approval on Jan 1st, 2021. Purchase agreement provided the entire transaction was subject to High Court approval, which is really there. But the way the transaction was structured, that any profit and losses arising out of the operation will belong to A, the acquirer. The purchase agreement provided management of BE will run the business as a trustee, which is normally the case, that you will not be doing anything which jeopardizes the business value which was really agreed, right? But they have to run in the trust, and therefore they cannot really take any significant drastic decisions with respect to that, and only in normal course they have to run the business in normal course of business. The High Court approves the transaction on 25th March 2021 and is filed with regulatory authority immediately. Now, I think the critical question here, there are three critical dates we saw. We saw the agreement was signed on 1st of July 2020. It was filed with High Court on 1st Jan 2021. And there, which is really there, and your High Court approval came on 25th March 2021. The question is, what will be the date on which I should be doing, or the company should be doing, the acquisition accounting? And the date will be the date when you are able to exercise control over the company. And the day when you are able to exercise the control can happen only when High Court approval or NCLT approval comes, because that's a very significant hurdle for company A to start exercising control, put their management on the board of the company, start taking all financial and operating policy decisions, and therefore the acquisition date will be 25th March 2021. Now, in the present case, if at all someone really does a purchase, if they start doing accounting from 1st of July 2020, you will realize that it can give a very drastically different result, right? So it's very, very important that we decide the right acquisition date. A lot of time, I think in High Court approval, now you find, okay, there are two types. One is appointed date, other is effective date. So a lot of time, the many court scheme will have an appointed date, which is not same as effective date. In those cases, you will start doing the accounting from effective date, but from appointed date, because in India, law overrides accounting standard. And therefore, it's very critical that when you as an auditor give a certificate for the particular transaction, you are sure that whether appointed date can be allowed to be different from effective date. Otherwise, the scheme will contain an accounting which may not exactly be in accordance with India's 103. In that case, as an auditor, then subsequently you may have to then give a matter of emphasis or a thing, because law overrides accounting standard, and you have to give accounting as per the accounting treatment given in the scheme. It was very, very critical that these aspects are understood well in time. At the time, as an auditor, we are giving a certificate for the scheme. This is absolutely critical that you really focus on concept of appointed date and effective date, because generally in a non-common control transaction, appointed date, it might be challenging to have any appointed date different than an effective date. In many cases, in few cases it may be possible, but in many cases, generally it will be aligned. And therefore, it's very, very critical that at the time when you're giving a certificate, you focus on this particular aspect, because when you come, once the transaction gets consummated and you have to start accounting for those particular transactions, you really need to think, then you have to really go as per the court scheme. But if there are transactions which is not happening as per the court scheme, let's say it is happening through just a normal business agreements which are really there will be a lot of time a condition precedents which will be put down into the acquisition agreement. It will be very important to understand which is the time frame by which you will be able to start exercising control over the financial and operating policy or decision. A lot of time, many condition precedent might be just procedural in nature, and some condition precedent will be very, very significant condition. So if something which is just procedural in nature may get really ignored, but something which is very, very significant or fundamental to the entire transaction has to be considered. And in those cases, you will really think, when is those condition precedent getting satisfied? You need to get those relevant information to crystallize the right acquisition date. So as an auditor, therefore, it's very important to understand what is the right acquisition date. And therefore, one of the biggest risk of misstatement is inappropriate evaluation of acquisition date. And what happens if you really have an inaccurate date of acquisition? The fair value all net assets acquired happens on date of acquisition. If at all the date of acquisition is assessed wrongly, your fair valuation will go wrong, and which will mean your assets and liabilities will be materially misstated. And therefore, one of the key risks, a lot of time management may have, or companies may have a particular a preference to go for a specific date. It's important to see that, avoid that risk if there is, that the date which management is assessed is appropriate and in accordance with Ind AS 103. The documentation and the condition precedents and the satisfaction of those condition precedents are not are documented appropriately to identify what is the right date. Therefore, the key thing again from a procedural perspective, you really need to understand the entire acquisition agreement. So you need to read acquisition agreement thoroughly. That's the first thing. You need to really understand whether it is subject to a regulatory approval or not. If yes, you need to understand, are those regulatory approvals substantive or not? Generally, all regulatory approvals like RBI approval, NCLT approval, Competition Commission approval are very substantive conditions. It cannot be regarded as procedural thing. Okay, so that has to be considered. You also need to see when do legally company has right to appoint board members. You need to understand and get input from the legal team when the company will be able to drive financial and operating policies, will be able to appoint the board members, etc. So I think that evaluation is important, and for that many times you may be requiring a legal opinion. You may even require data points or documentation with respect to satisfaction of those condition precedents. That is very, very important. A lot of time, even when the court order comes and filing of the court orders with ROC, only completes the entire process. So you need to also get all those relevant such kind of documentation from the company. Based on this, for that's one key aspect, reading of the acquisition agreement, understanding and reviewing the management analysis, getting confirmation, and really based on that, getting satisfied of whether the control has been acquired or not will be an important step or key audit procedure which everyone will need to really follow. Okay, I think moving further now, then if we have to go to step 3, then it's basically about everything about purchase consideration. And as you all know, the consideration in business combination can be cash, it can be equity shares. So, and what you really need to do as per Ind AS 103, you have to fair value the consideration transferred. So generally, consideration transferred in a business combination shall be measured at acquisition date fair value, which shall be calculated as sum of the following: acquisition date fair values of asset transferred by the acquirer, the liabilities incurred by the acquirer, and the equity interest issued by the acquirer. While if at all there is a non-financial consideration being paid, the valuation will become a lot more challenging, because you will have to then involve a fair value. If it is equity shares issued, and if it is equity shares of a company which is not listed, it involves a valuation aspect of an unlisted company. Valuation of an unlisted company is always challenging, so you need to have that part of it. The third thing is, and therefore that will drive the consideration. The other critical part in a consideration is whether the price paid is actually for business combination or for something else. A lot of time, there is the transaction is structured to pay even for post acquisition services. So if you see, many times there are earn-out arrangements been agreed as a part of business combination, and those earn-out arrangements are subject to satisfaction of certain performance conditions, and many times even subject to service condition. Now, if at all it is really related to a service condition, a question will arise whether it can be even be regarded as a consideration paid for business combination, or whether it should be regarded as consideration paid for post-acquisition services. If the assessment is that it is a consideration paid relating to post-acquisition services, it should be not be considered for business combination accounting. It should be accounted for separately as a employment cost. Whereas if at all it is not linked to employment, but it is linked to any other performance condition like EBITDA, revenue multiple, etc., you need to account for those consideration at fair value on the date of acquisition, and that fair value of those contingent consideration will be factored in the goodwill calculation. So having said that, it's very important to understand the substance of the transaction, where there will be fixed price, there will be a contingent consideration being paid, whether the cost which or the price which has been paid is for the business combination for or some other assets or some other services which are really there. And if that is the case, you really need to account for consideration accordingly. So important thing to really say that in case of contingent consideration, the initial treatment is you have to recognize the consideration paid at fair value. That fair value of the contingent consideration is factored it in acquisition accounting, and goodwill will be considered as per that. Post acquisition, changes in the fair value of the contingent consideration post the acquisition date will have to be accounted either in as per depending on the type of the instrument or the consideration which is really there. Generally, it will get accounted in P&L unless it will really warrant capitalization or accounted for in reserve as per Ind AS 32. Right. So that's how it really happens. If it's an equity, then ideally it is not remeasured. If it is liability, then any changes in the liability goes through P&L unless and until there is a specific treatment allowed to be taken to India as per Ind AS 32. But generally, it will be taken to P&L. So what are some key audit procedures when arrangement, when you, if you see that the consideration is including any contingent consideration, one should really worry about understand those, what is this contingency is based on, whether it is based on continuing employment, whether it is based on any performance measures, whether it is what is the duration of continuing employment, number of shares owned, whether the remuneration, the person who is getting, whether what is the level of remuneration, is it linked to the valuation. It is a very subjective exercise. Depending on this subjective evaluation, one will have to see whether the contingent consideration should be factored in business combination accounting or as a separate services thing. So one of the key, therefore, one of the key procedure is to understand read the shareholders agreement, understand the basis of the consideration, what all considerations is being paid. If it is paid in cash, not an issue, it's simple. If it is paid in equity shares, you need to fair value. So you will have to obtain the fair valuation report from the company. If it is listed company shares, then it's easy because there is a quoted fair valuation available. But if it is not, then you may have to even get the fair valuation report from the expert. You need to involve your specialist to see, are you getting satisfied with those particular inputs which has gone into fair valuation. If there is a contingent consideration, you need to understand what is the basis of contingent consideration. You need to obtain evaluation from the management saying that, okay, why do they believe it should be factored in as a part of business combination, or why it should not be accounted for separately. And that is something which is very, very important, and based on which you will have to really then understand whether you will agree with management assessment or not. I think the fourth step then, as we go further, is to see about the recognition principle, which is really there. So as of the acquisition date, if you see, one of the key part which is really there is all assets and liabilities which gets acquired as a part of acquisition has to be recorded at fair value on the date of acquisition, right? So something, and what is very critical, that we record only those assets and liabilities which we have acquired as a part of business combination. And Ind AS 103 gives a very detailed guidance on what are the recognition, what are the assets and liabilities which can get recorded, what assets and liabilities which you cannot recognize, how, and there are also a lot of how you should measure those assets and liabilities. And there are a lot of exemption and exceptions which are really listed down in Ind AS 103. So as you all know, I think some simple example is about intangible assets. lot of time intangible asset does not really feature in the financial statement of the acquiree. One of the very judgmental aspect of business combination accounting is whether we have recorded all intangible assets or not. Okay, the completeness of those assets and liabilities is a very critical step. So what kind of, for that, one has to really understand the substance of the transaction, what all assets and liability, what are the things. There could be distribution agreement, non-compete clauses can really impact those particular evaluation, brand value, brands which will really have an impact on that, distribution arrangement which will really have a lot of value for the company. So you really need to understand the basis of arriving at business value. What is that acquirer is really placing emphasis on? So understanding substance of the transaction is very, very important. And how do we understand those things? How do we get those data points? And therefore, it's not only the valuation report. One is, I think, our start base point will always be a valuation report, which will be taken by the management or internal evaluation done by the management. You need to have that. That's our start point. We also may have to go through the financial statements of the target. That can also give us a lot of data points, etc. And we can correlate back to the valuation report. That's a second other important thing. The third important thing is also the acquisition agreement, because it will talk about IPRs and contingent liabilities and indemnifications, some of those things which should really come into and record. So that's the third important data point which is really there. Fourth data points could also be the deal documentation, the due diligence report, and other things which can give you insights about, are you taking over any contingent liabilities? What are the kind of exposure companies really have? And therefore, are those assets and liabilities and contingencies been factored in our evaluation or not? So those are the 4 to 5 different data sources which you should really go through in detail and to really audit the evaluation done by the management, right? So that is very, very important. The other important part which is really there is with respect to important part is with respect to identification of intangible assets, and lot of time that thing will come also through understanding of the business which is really there. So if you are acquiring let's say a film company, you will really understand, okay, what are the value drivers of that particular business. It could be let's say the agreement with the cinema, the exhibitors, that could be a value why I'm really paying for them. Or there could be a library of content which they have developed on which I'm really doing that thing. If I'm really acquiring a real estate company which is really there probably there could not be much intangible asset, because I'm really paying a lot of emphasis on the tangible assets which I'm really doing. But if I'm really acquiring a pharma company, I will really place a lot of emphasis on distribution agreements. I will also place a lot of emphasis on IPRs or filings with their product registration which they really have. So understanding the nature or the value drivers of that business is very, very critical. The also other part which is really what is important is understand what are the other nuances. Like for example, pre-existing relationships with the client. If at all, because it has a very different accounting treatment under Ind AS. You pre-existing relationships should not be accounted as a part of business combination. It has to be accounted for separately. So if you already were having an existing relation supply contract with the acquirer, some of the value which you have then paid ideally will be attributed toward termination of those contracts. If you are holding shares in the acquirer, okay, or the acquirer was holding shares in you in that case, then it could be an acquisition of treasury shares and we need to do that thing. If it is a receivable payable arrangement, it could lead to an extinguishment. Therefore, there is always a contractual right to use acquirer's asset or acquire. Then there could be a repurchase of intangible assets which are really there. So if you have pre-existing relationship, we really need to worry about it. Also, what are transaction costs also is another important aspect which is really there. Transaction costs are only those incremental costs which is relating, which had the transaction not happened, we will not have really incurred that thing. So generally speaking, all transaction, ideally all transaction cost gets accounted, get charged off to profit and loss account, except for those if it is relating to issuance of equity shares or other stuff which is really there, then that will be accounted in accordance with Ind AS 32. So I think there are a lot of things if you really look at as this step of recognition of assets and liabilities. One of the key risks which comes to my mind is, have I recorded all assets and liabilities? The completeness assertion is very, very important. The second important assessment risk is, have I valued all assets and liabilities appropriately, or have I measured all assets and liabilities properly? And the key valuation aspect is the key assertion which I need to really worry about. Okay. The third aspect is rights and obligation. Okay. Have I considered all rights and obligation properly? Have I understood? So if at all an arrangement is with respect to termination of relationship or with respect to post-acquisition services, it will have a different nuances. So that's the third risk which we really need to address part of it. The fourth part of it is, have I measured things appropriately? Okay, that's a very important part of it. So and that those are some of the risks, and therefore the audit procedures also which we really need to do. If we say for completeness part, I may need to understand take the financial statement and match and marry the assets and liabilities which have been considered with the valuation report. I need to really do that. If required, one may even have to do certain type of physical verification procedure whether the actual assets and liabilities are coming on board or not. So how do you really get comfortable with it? For measurement purpose, management will have done a fair valuation. They may have used an expert. We may need to understand and take the valuation report, go through the inputs, do some sensitivity analysis as well. We may have to involve our in-house expert. The audit team will have to really use their own expert to challenge management assumptions, etc. And based on which you will be able to address the misstatement risk on the fair valuation. The third thing is the risk, as we spoke about, is rights and obligation. Detail, you are reading the entire acquisition agreement, the deal documentation will be very, very important for us to understand and will give us a comfort in terms of that, have we really considered all nuances? So if there are things which are linked to employment, if there are contingent consideration linked to employment, that should ideally give us a red flag to say that this should not be coming as a part of business combination. It should go as an expense account, right? So that's something which is very, very important. So prior audit experience, if at all, if we believe, I think in all these things, one of the important thing is how robust is the process which is instituted by management. What was our prior audit experience with respect to, and where any frauds or errors which was really noticed? If the business combination is getting consummated at a near period end, it's very, very high risk that management will not have been able to do a very robust assessment. And therefore, there's a high risk that material misstatement can happen. And therefore, we should really be very careful about transaction happening at the very fag end or a period end, which is really there. A lot of time, the assets and liabilities, especially intangible assets, as a lot of measurement uncertainty. If at all fair valuation is requiring a lot of level 3 inputs, the more I think the uncertainty and the cash flow based projections are really there, or there are a lot of other drivers which are not very, very specific in that case. In that case, there could be a significant measurement uncertainty. That's a key risk which we really need to be mindful about. Fourth thing is documentation is susceptible to manipulation. Because, for example, especially for intangible asset, if I don't want a very high value or I want a very high value in intangible asset, the projections might really be tailored in that particular way. And therefore, we need to be mindful about that risk. And we really need to do due sensitivity analysis on the projection used by management for fair valuation and inputs given to the experts in that case. If at all a valuation is done by not a very competent person, that is also a key risk for us. We need to be sure about the credentials of the specialist used by the management, whether they are the right person and with the right capability and competency. That's a very, very important aspect which we really need to employ. the completeness part of it, as I told you earlier, is a very important aspect which really requires a focus, attention. We may need to do specific procedures to get comfortable whether all assets and liabilities of the target have been considered for the goodwill calculation and recording. Okay. So I think those are some of the things which is really there. And again, I think the right level of person who understands business combination accounting should be involved in the evaluation. I think that is very, very important. These are some of the key risk of misstatement which we really need to worry about. So how do we mitigate those things? Again, detailed review of management analysis is important. Whether the consideration transfer has been appropriately measured. We need to, if required, we need to engage assistance of specialists, especially when the fair valuation aspect is involved, especially in contingent consideration which is involved, especially if at all the consideration fair valuation is arrived through prospective financial information that is involved. We need to really see whether the consideration has been appropriately classified as an equity or a liability. For that, a detailed review of the terms of the instruments which have been issued is very, very important. That needs to be analyzed. A detailed review of purchase and sale agreement, deal documentation will be required, and doing that thing. So I guess what other, while we spoke about all other things, one other important aspect is deferred tax impact on doing a business combination accounting. And many times we will have to involve tax specialists for this to see that whether the tax rates and everything has been appropriately been used for measurement of deferred taxes. I think some very peculiar things about contingent liabilities. If you see, Ind AS 103 also requires measurement or recording of contingent liabilities at fair value. And for that, one may have to even involve a legal expert, which is really there, who will give a possible, probable, remote, or give a estimation of a contingency, or what is the probability that the liability will befall, based on which the measurement will really happen. And for that, we may have to rely on the work of those particular or on those specialists, and we may have to follow the necessary procedures around that. So you need to really then get the valuation or the expert opinion on the contingencies and what is the chances of liability befalling on that, and maybe you have to rely on that. So you need to do certain necessary procedures to really get comfortable with the use of those experts. The last step, as we really discussed, was on measurement of goodwill and bargain purchase gain. So goodwill is nothing but an excess paid over the net assets acquired, right? So that's something where the goodwill will really be there. And in case where there are non-controlling interest, you need to do consideration plus fair value of non-controlling interest minus net asset acquired. That will result into goodwill. If you had a previously held interest, you need to be mindful about one fact, that you may have to fair value the existing stake in that company before doing the business combination accounting. And that may result into any significant gain or loss. So this is one aspect where I've seen a lot of companies have really ignored this part of it or made errors. So this is one red flag which everyone should be watchful about. Also, non-controlling interest, as you know, under Ind AS 103, there are two choices which are given. Either you can measure them at the proportionate of the fair value of the net assets acquired, or you can do fair value. And both of them can have a very significant impact on the value of goodwill. Because if you go with a proportionate net asset, then the goodwill only will be with respect to your share. Whereas if you do fair value, then the entire 100% goodwill will be reflected on the balance sheet, right? So based on that, when you do a goodwill impairment testing, also this could have a really bear. And these choices can be made on a transaction by transaction basis. Therefore, it's very critical that we obtain what choice management have really done. Is that appropriately documented and appropriately disclosed in the financial statement? That's a very important aspect which is really there. So one, the key risk from goodwill calculation perspective is, have we computed goodwill or bargain purchase appropriately or not? Have we fair valued the previously held interest or not? And if at all it's a bargain purchase, it's very important to reassess the fair valuation done. That is the fair valuation done appropriately or not? So that something is thing, and I think the key from a key audit procedure perspective, it's very important that we do a reperformance of the management computation, which is really there. We take and tie every aspect. So net assets acquired will get tied back with the valuation report and the financial statement, which is the consideration paid really gets tied back, and if there is any fair valuation involved, we use an expert to really see whether the fair valuation done by the management is appropriate or not. And based on if there is a bargain purchase, we really understand why the bargain purchase gain is coming. Because for that, one has to really understand the substance of the transaction. Therefore, we may have to really do a lot of inquiry-based procedures to understand the deal dynamics, and based on which why necessary things are here, why bargain purchase is coming. So that's the critical aspect on this. So I think with this, I think we covered at least all key steps, which is really there. As we also know that in case of any accounting for business combination, all the steps were relevant for non-common control transaction, but common control transaction we do based on book values, right? So, but therefore, let's quickly recap what is common control transaction and how does it really get accounted for, and also let's understand what are some of the key risks in a common control transaction which we really need to be mindful about. So a common control transaction is where both before and after the transaction, it remains under the same controlling party, okay, or parties in that way. So here, if we look at it, A Limited holds 100% in B Limited and C Limited. B Limited holds D Limited and C Limited holds E Limited. If E Limited is amalgamated with D Limited, even after the transaction, it is ultimately controlled by A Limited. And therefore, this will be regarded as a common control transaction. And as you all know, for common control transaction, there is a detailed guidance given in Appendix C to Ind AS 103. It basically requires all assets and liabilities of combining entities are reflected at the carrying amount. No new goodwill is allowed to be recognized. Financial information in financial statement in respect of prior period should be restated as if business combination had occurred from the start of the preceding period, if assuming that they were under common control from the start of the preceding period or from the time it came under common control. All considerations which are issued are measured at if it is cash, there's no issue, but if it is equity shares, it is valued at nominal value. Identity of reserves shall be preserved. That generally is the case when transactions are structured in form of mergers and other things. But if case of a demerger, there is always this nuances where demerger does not travel. The reserves of the transfer business does not travel unless until one can really justify that part of it. In case of merger, this is a very common thing that reserves also get travel to the transferee entity. And difference between the considered amount recorded as share capital plus any additional consideration really gets adjusted to capital reserve. So that's broadly the thing. I think one of the key aspect or risk of misstatement here is, first of all, to assess whether the transaction is actually a common control transaction or not. That evaluation itself is a very subjective exercise. So if it's a parent subsidiary merger, it's easier thing. But if the subsidiary has just come into a parent fold only 1 or 2 months before, again, the transitory control thing will really get triggered, and therefore it will become a lot more judgmental. So let me give you a very simple example where a company A acquired company B with an intent to really do a merger. So immediately on acquisition of the 100% stake, it filed a scheme of merger, which is really there. And merger really happened after 6 months' time. And they filed a scheme of merger after 6 months' time. Now the question is, from a standalone financial statement perspective, whether you will treat it as a common control or not a common control. Because if you treat it as a common control, you will have to do through a book value accounting. And if it is not a common control, you will do a fair value accounting. So that is why it's very important that how do you really take care of it. So whether the 6 months is a transit will meet the transitory control definition or not is a judgment aspect which needs to be really analyzed. Therefore, one of the key risks or the key audit procedure is one will have to understand the relationship of the parties to the transaction, determine whether transaction should be accounted for as business combination or not. Review management evaluation of common control. We need to get a detailed evaluation from the management, also with a very specific focus on review of transitory control or not. And if at all we assess whether so that's one aspect part of it. The other important part about it is reflection of assets and liabilities book value. So if you see there is common control accounting very clear, all assets and liabilities has to be recorded at book values, at the carrying amount. But at which carrying amount? So let's say if the parent and a subsidiary is getting merged with the parent, the question is whether what is the carrying amount? Should the parent reflect at the value which was reflected in CFS, or parent should reflect the value which is reflected in the standalone financial statement of subsidiary? Now there could be judgment as part of it like that, because if you see there's an ITFG on business combination which says that in case of subsidiary merging with the parent, then parent can push down the CFS value. So I think this point should really be considered to see whether what is the value at which it is really reflected. However, but when two fellow subsidiaries merge with each other, they cannot really reflect the values which is reflected in consolidated financial statement. So there are these nuances around that. Therefore, it's very important to understand what is the policy which management has really adopted and what book values it is really incorporating or recording in the transaction. The second important part about it is you need to restate the comparative period as if you were always under from the time you came under common control. In many of those things, what will happen is therefore in the past period, if there are a lot of intra-group transactions which will have happened, one will have to knock off those transactions, right? And reflect those things appropriately. So doing that part of it and doing a restatement is also not an easy exercise. You need to have a detailed working from the management of how the restatement has really happened and whether it is appropriately and duly reconciled that with the financial statement, right? So that something is a very, very important exercise to be done. So we really need to be very carefully looking at that aspect very well. And a third thing is reflecting of like if there are equity shares issued, even if the equity shares issued at whatever value, you may have to record it at nominal value. It's very important to really take care of these aspects, which is really there, that equity shares are reflected at nominal value. So these are some of the area to really watch out for, and how do you really manage that part of it, and some of the key risk and the audit part of it, which you really need to take care. I think having considered this, it's the risk does not really just ends the moment you do day one accounting, but it's very, very important that you focus also on post-acquisition risk as well. One important area which is really there is in any business combination where goodwill is really there. One of the key thing which one is to focus on is whether there is any change in cash generating unit, whether there is a need for adding additional segment, whether there's any impact on segment reporting, what happens to goodwill, how do you do goodwill impairment test, do the management have a robust process of really going and doing an annual impairment testing of goodwill? That's important. How robust is the process which has been set up? Is the business projection used by the management for doing impairment testing, is that reasonable or not? Managing the fair valuation and depreciation calculations of fixed assets and intangible asset is an important exercise. The volume of fixed asset is quite great. One will have to be very, very mindful about the aspect, is the depreciation calculation appropriately done? And that is very, very important. What is the useful life of intangible assets, which is in sync with what was considered as a part of valuation report? If it is not, if it is different, what are the reasons for management to really take a different value than what was considered in the valuation report? Accounting for deferred taxes is very, very important. whether it has been appropriately been calculated or not. And that something is very, very important. The post-acquisition transaction, post-acquisition, the day two accounting of contingent consideration on every subsequent reporting date, the fair valuation of it, is it appropriately done or not? That is very, very important. If you record contingent liabilities at fair value, how do you really do and manage that thing on a subsequent basis? Whether possible, probable, remote, those assessment has been done appropriately or not. Those are some of the key risk of mixed misstatement which you really need to do. And therefore, what are some key audit procedures? I think one thing with respect to goodwill impairment test, we need to really obtain the management working of goodwill impairment. We need to obtain business projections which are really there. We need to understand if what are the inputs which are really going on, the assumptions which are really done. We may have to involve our specialists to test management assumptions. We may need to really do sensitivity analysis and ask whether do a realistic assumption, pessimistic assumption, and aggressive thing to really see what is the change in the assumption, how much impact it will have on headroom. Internal financial control evaluation, impact on IFC of the company is very, very important. How is the target internal financial control aligned with the company's internal financial control? What are the changes in RACM and other things, which are, whether it has been done or not? Especially, let's say, fixed asset registers, whether how is going to update, whether it is updated on Excel workbooks or whether it is updated on systems, ERP system, whether depreciation calculation is manually done on spreadsheet or depreciation calculations is done through the system. Some of those aspects will really be very, very important. Therefore, if at all it is done on an Excel workbook, we'll have to re-perform and tick and tie and reconcile that with the valuation report. Same thing which is done in the ERP system, whatever inputs which has really been done, we need to cross-check and reconcile those things with valuation report. We need to take the assumptions of whatever useful life assumptions have been done. We need to really reconcile back with assumption used in the valuation report. Wherever deviations are really there, we need to ask management assessment of why they have taken a different useful life than what was considered by the valuer. That is very, very important. We need to obtain a deferred tax calculation sheets, which are really there. For that, we may have to involve our tax expert to see whether the tax rate is appropriately done or not. So some of those, I think these are some key audit procedures which we really need to worry about. I think the last and I think the most the critical part of it is about the presentation and disclosures with respect to business combination accounting. For all business combination that occurred during the current reporting period or after the reporting period, these are the following. I think there are plethora of disclosures which are really asked for. Some of the key disclosures which are really there is with respect to the fair valuation of net assets, the goodwill calculations. You also need to give, the company also need to give a pro forma disclosure as if the business combination had happened from the start of the current period, how the key KPIs will really look like. So that is something which has to be really done. And some of those goodwill, there's a detailed disclosure with respect to goodwill and impairment of goodwill that will be very, very relevant. So one of the key risks in presentation and disclosure part of it is, first of all, whether all disclosure which is required by Ind AS 103 has been given or not. The second important part is whether the fair valuation is basically based on level 1, level 2, or level 3, and if it is based on level 3, whether the required data is available. Is there something which is looking reasonable or not? The third thing which is really there is the quality of disclosure. While disclosure may be given, but whether the quality of disclosure is appropriate to in line with considering the purpose why that disclosure have been really asked for, and is there a risk of is there any disclosure which is purposely aggregated or given in such a way with to avoid any material information being passed on to the readers of the financial statement. So what are some of the key things we need to do? We need to check the completeness and accuracy of disclosures given in the financial statements. We need to trace the backup workings for the disclosure, okay, and need to reconcile with the fair valuation reports and other things. We need to discuss with the management if there is any significant changes after the mergers and acquisitions which has really happened. We need to check the wordings used by the management in presentation, whether it gives a fair, so quality of disclosure which are really there. Also, from an ICFR perspective, we need to see if management updated their disclosure checklist. Has management really the review of disclosure, the wordings and other thing, is it prepared by and approved by? Is that really happened or not? The fair valuation, whether the fair valuation disclosures and other things have been appropriately given in the financial statement, the competency of the valuers which has been used. So some of those are the key audit procedures which we will have to really do. So I think these are all the entire gamut of audit of business combination. If I have to really sum up from the entire value journey from the start, which is really there. As an auditor, we really get involved in the entire business combination cycle from the time the business combinations are really envisaged, especially when the transactions are done through court scheme, because that's the first time when the management will ask us to give a certificate, okay, which for the accounting treatment to be given in the scheme. It's very, very important that we take appropriate care at that from that point in time to understand the transaction structure, understand the basis of the transaction, so that the accounting treatment which we certify is in accordance with India's 103. And for that, especially special focus should be there, understanding whether the appointed date and effective date should be same or not, and other things. So that's very, very important. The second thing, once the business combination is done and we are doing, we also need to really understand about any business combination. Going through that particular step is going through the entire, understanding the entire transaction, understanding the substance of the transaction, understanding all assets and liabilities of the transaction, what assets and liabilities we are inheriting, reconciling back to the financial statements of the target. That's a very important process which is really there. We really need to see which all fair valuation experts we need to involve. One is the valuation expert, other is tax expert, third could be legal expert. So we need to ensure that do we have enough competence in the team to test some of those areas or not, and that is very, very important. And fourth part, I think we really need to start focusing on is the internal financial controls, which is really there. We really need to see what level of documentation company has maintained. What is the process which is instituted by the management? At the time, do they have, what kind of memos have been prepared? Who has prepared it? Who has approved that part of it? If at all, do they have a proper disclosure checklist covering all business combination or not? Or not? So that is something which is very, very important. Do they have in-house valuation expert, or are they taking help of an outside specialist in that? Even if they are taking a use of an outside specialist, what is the process which has been instituted by management to really give the data to the valuation expert? And the process, internal controls around that part of it. That is a very important focus area which we as an auditors will really be focused on. So I think with that's broadly what I thought I would like to cover, and from an audit of a business combination. Now over to you, Anilji, if at all you have got any questions from the participants. Hello. Hello. Emil, am I audible? If Anil, okay.
Okay, sir. Okay, sir. Okay, sir. Okay. Okay, sir. Let me check. Please, please. Thank you. Thank you, sir. Thank you so much. Sir, can you hear me?
Yes, I can hear you. Yes.
Sir, there are certain questions. So
Right.
first question is whether valuation of business combinations, that is assets acquired, is measured certainly.
If I understand you right, whether valuation of assets acquired has to be fair valued or not, is that the question?
Yeah, assets acquired is to be measured certainly. Fair value,
Yes.
yes.
So I think the standard is very clear that all assets and liabilities acquired as a part of business combination have to be fair valued. There are few measurement exceptions which are there, but generally speaking, all assets will generally be fair value. And there are no exceptions around that.
Yes, sir. Sir, one member is asking if it is possible, kindly put some more light on acquisition or purchase of an existing business with exchange of any consideration. Does it limit the control of the acquirer over the acquired?
Right. So, okay. So let me see when we let's give a simple example. Let's say you first acquire company A acquires 40% in company B, but it does not have anything. So in that case, can you say you have controlled that entity? Ideally, answer will be no, because unless until you will have a 60% person who can block all your decision making, if they can come together, you on your own will not be able to take any significant financial and operating policy decision. But however, by virtue of this 40%, or let's say if you have 48% and other 52% is very widely dispersed, then in that case, there could be scenario that even if you are not owning majority, you can still control. Now, if you now start acquiring, let's say you acquire another 60% stake, which is really there. Okay. In that case, if I understand the question which was really asked is that how does various acquisition, what form of, if at all we acquire 40% and we then acquire another balance stake, how it will really impact the measurement? Is that, have I understood right question, Anilji, or is there?
Yes, sir, yes, sir.
Right. So if at all, let's say we acquired 40%, then we were not having control, but we acquired another 20% and we acquire control, then the way it will work is on the date of when we acquired 60% and additional stake and our cumulative stake becomes 60%, we say we have got control. We will fair value all the net assets on that day. The consideration which we will the way it will be arrived at is whatever was the original 40% will be fair valued on the date of acquisition. Therefore, the difference between the fair value on the date of acquisition of the earlier 40% stake minus the carrying value will go to P&L plus, and then that is the 40%. So therefore, you will arrive at a 40% stake fair value on the date of acquisition. You will add the consideration paid for the incremental 20%. That total value will be compared with net assets, and that difference between the net assets and the consideration paid will be regarded as goodwill or capital reserve.
Yes. So one question is a specific question. Member is asking: A Limited is a parent of B Limited and C Limited. A Limited is a parent of B Limited and C Limited since 1st April 2018.
Okay.
On 1st August 2021, B Limited acquired 100% shareholding of C Limited.
Okay.
How B Limited will account the result of C Limited in its books for the financial year 21-22?
Since I think, so if I understand right, Anilji, what you said is A Limited has two subsidiaries, B Limited and C Limited.
Yes, sir, B and C.
And they were all under same umbrella of A Limited since 2018. In 2021, B Limited and C Limited are merging or acquiring in that. It will be regarded as a common control transaction, and the transaction will be done based on book value. And you will have to restate as per Appendix C to Ind AS 103. And so you the entire transaction will be recorded. All assets and liabilities will be recorded at carrying values. There will be no goodwill or bargain purchase thing will be coming. Any equity shares issued will be recorded at nominal value, and difference between consideration paid and the net assets acquired will be reflected in capital reserve.
Yes, sir. Sir, in audit of business combination is beneficial for the proprietorship firm, and how we get such type of audit and point we consider in audit.
Audit of a proprietorship firm, generally we will be for, I think the audit consideration remains the same. For or proprietorship firm, more likely than not, whatever discussion I did was in context of Ind AS. Ideally, for proprietorship firm, they will have to follow accounting standard issued by ICAI. There, if at all, there are in ICI accounting standard issued by ICAI, there are one standard is AS 14. So if it is a merger or something like that, then or if it's a slump sale, ideally the acquisition accounting will be, or you will the transaction will generally be in form of business acquisition. And there is no specific accounting standard given in ICAI to really see how to account for business combination acquisition or acquisition of business. So one may have to draw analogy from the past standard. Generally, it also gets accounted at business at fair value only, taking analogy from Ind AS standards which are there or MCA standards. So, and the audit consideration which I discussed here, a lot of things will be relevant even for proprietorship firm. So if you record this transaction at fair value, whether the assets and liabilities are appropriately reflected at fair value, all the audit procedures relating to that may equally be relevant for audit of proprietorship firm as well.
Yes. Sir, in case of common control transactions, the impact only at the ultimate holding company needs to be considered, or impact on the intermediate subsidiaries also has to be considered.
It all depends on the level at which the common control transactions are happening. So in the earlier example, if we say there is a parent A which has two fellow subsidiaries B and C, if the transaction is happening between B and C, that is C is getting merged with B, the impact will be happening given in the books of B, okay, and not and in A's standalone books there will be no impact. In A's consolidated financial statement, ideally there will be no impact because they were always just continuing to remain the same group itself. However, there could be some impact on accounting for non-controlling interest depending on the type of the transaction. But ideally, the impact will more significant from a B's perspective. That's how I will put it.
Yes, yes. Sir, in case of the common control merger, where the NCLT order is received, will the goodwill or capital reserve computation be performed based on the book value of net assets of the acquirer, or as at the effective date of merger mentioned in the NCLT order, or the date the NCLT order was received?
So as I have explained earlier, in case of common control transaction, ideally there will be no goodwill or negative goodwill or bargain purchase or gain or loss will come. So there's no question of any goodwill recording in common control transaction.
Yes, sir.
And accounting will the entire accounting is done based on book values.
Sir, the second last question. If 100% shares of acquiry are purchased in cash or bank, how will business combination be accounted in books of acquirer, whether in such case in CFS, fair value of acquirer assets?
Can you repeat the question again, Anirji?
Sir, question is, if 100% shares of the acquiry are purchased in cash or bank, how will business combination be accounted in books of acquirer, whether in such cases CFS, fair value of acquiry assets?
Right. So you are right. It all depends, first of all, on acquisition. So I think the first presumption we should say is that acquirer is acquiring a business. Second, if it is all the assets and liabilities of the target will get reflected at fair value. The difference between the cash consideration paid or the entire consideration paid vis-a-vis the net assets acquired will be reflected as goodwill. That is how the accounting will really happen.
Yes, sir. So what will be the treatment of profit arises on account of reinstatement of the comparative year financial figures in case of common control transaction?
Right, that's an interesting question. I guess here, what happens is, so in case of common control transaction, let's say, let's understand this thing with a simple example. Let's say there was there's a subsidiary B which is getting merged with parent A. Let's say in that way, and they were always under common control. Now subsidiary B, and let's say the scheme is the merger is happening from 1st of April. Let's say scheme is really effective from 1st of January 23. Okay. What will happen in 20 to 23 up to December 22? B will have prepared its financial statements. It will be there. And they will have reflected profits and everything. They will have declared the profit and loss, etc. Now, A will account for this transaction on the effective date. Let's say effective date is happening on 1st of January 23. It will account for as if they were always together. So it will not only account for, it will go back and account from 1st April 21. So for a 21-22, the profit and loss, all assets and liabilities on 1st April 21 of target of the B will get reflected and in the comparative period as on 1st April 21. 21-22 profit of B will also get reflected in comparative period of A and up to the December in that case. So everything, so it will be accounted as if it was always together. So the profit of the previous period will also be reflected in the financial statement of A in the comparative period.
Yes, sir. So last question. If 100% equity of a company B is acquired by a company A, which confirms the business combination requirements, and subsequently within 2 months, company B acquires 60% of company C, in which company A already holds 40%. Whether the second acquisition to be treated as common control transaction in company A or business combination in company B?
Okay. So if I understand what you're saying is company A acquired company B, okay, first through cash 100% acquisition. Company B acquired company C, in which company A was already holding 40%, right? That's the fact pattern which is given in the question. Am I right, Anirji?
Yes, sir. Yes, sir.
Right. In this case, it all depends whether by virtue of what, first of all, company A acquired company B only recently. In that it came under the fold, so only recently, and for first of all, by virtue of 40% stake in company C, whether A was controlling C or not is a matter of judgment, right? It is first we need to be assessed whether company A was controlling company C. So let's take scenario A, two scenarios. Scenario A, company A was not controlling company C. In that case, company A first acquired company B, it will do acquisition accounting for company B. Company B acquired company C. In that case, they will do acquisition accounting. Company B will do acquisition accounting for his own CFS. Company A will also do acquisition accounting for his CFS. And in that CFS, it will have to fair value the 40% existing stake for doing the acquisition accounting. So there could be a difference in the way acquisition accounting happens at B level and company A level. That now in scenario 2, let's say where I said company A was already controlling company C, right? So first company A acquired company B and then company B acquires company C. Now here the critical part will be whether this was whether it is a common control or not. Might be a challenge because company B came into company A fold only very recently. So one may have to really think and one have to really analyze the substance to see whether this will meet transitory control criterion or not. If it is not a transitory control criterion is not met, okay, then it will be a common control. But if it is transitory control criterion is met, then it may not be regarded as common control. So it is with more factual assessment, a lot more fact pattern is required before one can conclude on this particular question.
Yes, sir. So now we come to an end, sir. Thank you so much on behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India. for sparing your valuable time and enlighten all of us on various aspects of audit of business combinations. Thoroughly, I have gained a lot through your deliberation. Hope our members have also gained a lot through your deliberation, as well as you have answered all their queries. They have. I have skipped certain questions which you have already covered in your presentation, but I have gained a lot, sir. Thank you so much once again for your wonderful deliberation, sir. Thank you so much. Thank you.
Thank you. Thanks a lot. Thank you.
Thank you, sir. Namaste.
Namaste.